It's always something. Could not get the collaborate to connect tonight. Anyway, I'm on the road. I'm down in Florida right now, so it was going to be kind of a stretch anyway, but I thought we could pull this off. Anyway, I will put this one out on YouTube this evening, so other than not being able to, chat or anything, it should be roughly the same. Most of you have probably already started the test, the midterm. If you're having any problems, let me know. But otherwise, everything should be going well. Also on the project, you should be, underway on your project. And again, let me know if you have any problems with that. So what we're going to be talking about tonight is insurance. So most people are familiar with the concept of insurance, but there's some specifics that we'll discuss here a little bit. It's all about risk management. I mean, that's why you have insurance. For the ultra wealthy, they call it self-insurance, and it's actually not a bad way to go if you can afford to do it. But for most of us, it's not possible. And if you did if you were self-insured, which meant you would cover whatever damages you caused or anything like that, for most of us it'd be catastrophic and financially. And anyway, it's not something that most of us can do. So anyway, what you do is primarily home and auto type insurance is what we're going to talk about tonight. Anyway, it all has to do with odds. There's actuaries out there who, just like in life insurance, they kind of know based upon your health and average lifespan, they know, when you're going to die. Well, insurance people also, based upon driving and odds, and basically it's a gamble like anything else. They know, that a certain number of people are going to have some sort of damage to their property or their auto, and by spreading that risk, by doing it collectively, they can offer you a product that is usually at a reasonable price that will protect you and your assets in case of a catastrophic loss. So anyway, there's insurance companies involved in it. There's also the federal government's involved in certain aspects of it, like the flood program. That's strictly a federal program. That's not a private insurance program, because it would be catastrophic to the insurance companies, just the nature of floods, especially like here on the Gulf Coast where I'm at right now. When hurricanes happen, it would absolutely sink an insurance company if they were responsible for flood damage type things. Anyway, we'll talk more about that as we go. What we're talking about, the basic principle is risk. Okay, so this uncertainty, lack of predictability, peril are the bad things that can happen. Peril are the actions like the fire, the windstorm, flood, death, those type of things are the peril. And hazards are things that increase the likelihood. So hazards are, bad things, usually under your control, sometimes not, but, driving drunk obviously is under your control, but a windstorm and a flood, sometimes you have control of it based upon where you live, but again, there's acts of God, those types of things. And then risk management is the actual strategy that you'd use to protect yourself. So pure risk. So these, what they want to do is they want to associate risk from some sort of investment or speculation. Pure risk is something that it's only a downside, insurable. There's a chance of loss, not gain, is what they mean in that second bullet. If you can potentially win in this situation, well, legally that's not something you can get insurance for. Now again, in investments, sometimes there's margins and things you can put up to safeguard yourself, but in the true sense of the word, that's not insurance, and that's not something that insurance companies get involved with. So nature and financial loss of the risk can be predicted, obviously, or else the insurance companies wouldn't be able to insure you. Again, they're going to do some calculations. They're going to figure out what's the risk involved, and then based upon the pool of people, and again, it's the numbers that make it all work. The fact that not everybody is going to wreck their car on a certain day, and if they're insuring, a million folks, they're still going to be profitable, even if a few folks get in an accident. Again, it's a lot more involved than that, but it has to do with keeping the numbers up. In fact, if you keep looking at this whole Obamacare, I'm sure we're all beat to death on it. But one of the problems they're really going to have, and this has to do with medical insurance, but if they don't get the numbers up of the low risk people, which would be people pretty much like yourself that are young and healthy, if they can't get them to pull in the pool, then they're going to have real problems financing it. If old people are in insurance, well, they're probably going to be the ones who use it. So anyway, in driving, it's almost the opposite. Although the ultra old, they do have higher insurance because, and auto insurance because they tend to get in more accidents. But young drivers, especially new drivers, we're talking the 16, 18, well, actually rental car companies won't typically even rent your car till you hit 25. So anyway, younger drivers, either based upon lack of experience when they're really young or kind of a bulletproof attitude until they hit about 25 and get kids and jobs and get scared once or twice, again, they tend to have more accidents. Speculative risk, this is the stuff that can't be insured. This is gambling, basically, real gambling, where there's a chance of actually winning. In a car wreck, no, you're not going to win. And if they do total your car, you should just get the amount that's due in terms of the car. You would not consider that a win. So again, here's what we've got in terms of risk management techniques. Risk avoidance, again, going back to the car analogy. You can avoid the risk by not driving. Well, but can you? So that's probably not a viable strategy. Risk reduction, you can do that, or at least you can lessen the impact. If you have airbags in your car, if you're wearing seat belts, the chance of you spending as much of the insurance company's money by you getting seriously injured is reduced. So risk reduction would be you taking measures to make sure you don't get hurt quite as bad, or perhaps driving a lower speed and all that kind of stuff. The risk shifting, the risk assumption, that has to do with the role that insurance companies play. So you shift the risk to the insurance company, and the insurance company also assumes the risk. So different strategies. Insurance program, how much? Well, what should be insured for how much? What kind of insurance? There's going to be minimums, especially in automobile minimums. And we'll look at the Alaska standards. They're done by states, but again, sometimes these folks can give you enough rope to hang yourself. If you want to go with a bare minimum of insurance, maybe that's appropriate if you don't have a huge amount of assets. But if you're pretty well set in life, later in life, and you exceed the amounts that your insurance covers, which you can do. You can carry, what would be considered underinsurance, but still meeting the legal definition of the requirement for insurance in Alaska. You would be on the hook for that difference. So we'll talk more about that when we look at the limits. Planning insurance. So set up your insurance goals, prioritize them, develop a plan, put the plan into action. Again, they're going to go through this circular type process, but really, again, any type of insurance calculation, what you need, that's going to be a snapshot, and it's only accurate for that one time. As your assets change, as your situation changes, so should your insurance. So if you've got a decent insurance company, when you call up about one policy, they'll usually go through a review of all your policies to make sure that they're sort of logical. And again, it helps if you have somebody who doesn't really have a stake in the game, somebody who's more independent. If it's a insurance agent who's on commission, who the more they sell you, the more profit they get, that's not an ideal situation. The auto insurance company that I've got, actually a lot of times they've reduced the coverage I've got depending on the situation, or have corrected redundant coverage, due to multiple vehicles and things like that. So if you've got a company that you can trust, that's very helpful. And again, the company, appropriateness of me mentioning private companies is probably questionable, but I do have USA, and they're pretty highly rated. But there are other companies out there that have that same sort of credibility. So again, a little research on your part, because other consumers are out there rating them, and look for somebody who's got a good track record and is highly sought after. Property and liability insurance. This whole statement about in recent years there have been major losses. There's always losses. I mean, they're more newsworthy now. But fires, hurricanes, tornadoes, all that stuff has happened. In fact, this is the only year that the only year I can remember where they haven't had a hurricane down here in the Gulf Coast. So that's a little different. Up in Alaska, obviously, different types of threats. But things like earthquakes are going to be, depends on your situation. It depends on your elevation too, in terms of the perils they can pose. But obviously, a massive earthquake can do pretty significant damage. Hurricanes, tornadoes, no. Floods can get you almost anywhere, but floods again are usually covered under a federal program, which requires a separate policy. So, anyway, natural disasters can and will happen. When your property losses, again, the home, automobiles, furniture, clothing, all that stuff can happen. Automobiles, if your automobile's in your garage, it's still going to be covered typically under your automobile policy, so that's not a separate item. And then the hazards, a lot of time, especially in the case of fire, the fire may do some damage, but typically, or in many cases, it's put out pretty quick, but the water and smoke can destroy a lot more in terms of dollar value. So, robbery, burglary, vandalism, arson, hopefully not, but it can happen. So, there's different types of things. Now, this is where, if you don't have insurance, liability are things like, say you hit somebody, you are liable. You're at fault. Or if somebody comes into your property and, say you're unfortunate enough to have a swimming pool that a child got killed, and you are liable unless you've taken, prudent measures. Negligence, again, this would, in the case of a swimming pool or some sort of hazard, if you didn't take reasonable care, you could be found liable. And then vicarious liability, that's somebody else, causing that problem. So your child throwing the ball through the neighbor's window, no doubt you are on the hook for that. So again, the courts too will tend to go after the person with the deep pockets. So, if somebody is seriously injured, it's not always fair, but the person with the money will typically be the one that the lawyers and the courts will focus upon. So you need to have some protection. Homeowners insurance, you have, there's a lot more to it in terms of homeowners insurance. If you do, have a house destroyed or whatever, there's other things that can happen. If you're pushed out of that house and have to live someplace else, that can get pretty expensive. Personal property floater, you'd be surprised at the number of things that aren't covered. There'll be a certain limitation, like say, it depends on your homeowner's insurance, but it may be something like $1,000 total for guns or jewelry or whatever. And if you've got, a couple gun safes or some expensive jewelry, you need to talk to the insurance company beforehand, and it's usually pretty reasonable, but you get a floater, what they call it, and that's where you go through and you identify and specifically list out those high value items, and you make sure that they're insured. The household inventory, it's much easier to reestablish and file a claim if you have a list of what you have in the house. Now, again, that can be pretty difficult to come up with a list, but what is pretty simple and pretty much everybody has availability of is just a digital camera. So again, you'd want to list out the high value items, but you'd also want to, maybe once a year or something like that, kind of take some pictures around the house. So, when the TV set, the stereo, all that stuff is burned up, you can reconstruct from a photo and kind of create that list after the fact. And the insurance companies are much more apt to, be reasonable with you if you actually have the list of items. Many times in arson, they can tell when it's an arson because people will tend to have all their family photos and everything else doesn't get destroyed. It's miraculously stored someplace else. So that's kind of fishy. But um, obviously the insurance company can't help you out with photos and things like that. But for the material objects, they can help you replace them. Again, too, when you're talking to an insurance company, it's key that you know a couple things, whether it's replacement value or it's just the value as depreciated. So, replacement value would be your TV set is destroyed, they buy you a new TV. If your TV set is destroyed and you don't have the full replacement value, they may say, well, that's a 7-year old TV. TVs last, 7 years, and it's basically a total loss for you. So, not necessarily the fairest method. So you want to make sure that that's done beforehand, and you know where you set. Medical payments, personal liability. This gets up into some of the, primarily covered under automobile insurance also. But let's say somebody trips and falls, on your property. You have somebody come on your property to do some sort of work, and you have some sort of hazard that, in this case, you're probably negligent about. Let's say you left a ladder in a strange position with something up on top of it. That something falls down, hurts that person. You need to have insurance for that. Now, again, this will be typically covered under your homeowner's insurance, so you don't have to itemize that out. But what you do want to make sure is that you have, the personal liability coverage. So in this case, they're saying $100,000. Now, again, this is where, review is necessary when you're talking to the insurance folks to make sure that your amounts are reasonable. And typically, homeowners insurance is not that expensive. So you'll also have, if you're carrying a mortgage on the home, they'll require you to have insurance for the structure because that structure is collateral for the loan. So the mortgage company will be very keen to make sure that your insurance is in place. They can also get kind of screwy. I've got a mortgage through Wells Fargo, and they happened to contact me and say that I was basically underinsured because I'd only allowed, say, a couple $100,000 to rebuild the structure of my home, and they were saying the loan was worth nearly $400,000. Well, what they weren't looking at though is, in the worst case, if there's a fire, there's nothing going to happen to the property, right? So the value of that home, let's say the home's worth $400,000, 150,000, 200,000 of that is the property. So they wanted me to put down basically $400,000 worth of insurance on the structure. So again, there's some gamesmanship, but the good thing is I don't have my insurance through Wells Fargo, so I went back to my insurance company, explained the situation, and they said, yeah, you're correct. They basically want me to carry extra insurance, which is not a good thing. If you do carry extra insurance, all they're going to do is repay the house. There's not going to be any cash payment. So, underinsurance is not good, but overinsurance is just as bad. It's just going to be a drain. Specialized coverage, endorsements. This would be, depending on your area. Earthquake damage typically covered. Again, there's zones even within, let's say the municipality of Anchorage or Alaska in general. There's certain areas that are more prone to earthquakes and not. So you look in those zones. The other thing is the flood damage. There's flood zones and there's non-flood zones. So certain zones are fairly low likelihood of flood, so you don't have to worry about it. But you want to double check that. There's also structures, and again, there's a beautiful house in my neighborhood that's vacant because it's built in an avalanche zone and it's uninsurable. So certain times, you know, you can be there can be a peril such as an avalanche, and because of where the house is built, the hazard is too great and it's uninsurable. In this case, nobody can buy the home because no mortgage company in their right mind will loan on a home that could be wiped out. So again, you know, those homes exist. Again, you know, in the real estate business, I know of a number of homes that were in avalanche zones, and hey, if you're a cash buyer and you're willing to accept it, then go right ahead. But you're basically self-insured at that point, and trying to get an endorsement from an insurance company in that case would not happen. Again, it depends on the severity of the avalanche zone in that case. Renter's insurance, always a good idea. My daughter down at college, they required her to have renter's insurance as a condition of the lease, and that can be quite common too, because again, the deep pockets type thing. If say a college tenant gets in a problem, and they don't have renter's insurance, then the person who got injured, tries to sue the college student. Obviously, no luck if they don't have the insurance, and so they're probably going to go after the landlord. Well, the landlord, in order to protect themselves, usually wants that tenant to have insurance. And again, the price on renter's insurance, we're talking typically under $100 a year. I mean, it's not that much, but depends what you put on the rider. If you have floaters for certain items, and again, if you're a renter in a college type situation, you've got a $1,500, $2,000 computer, you would probably want to specifically identify that and make sure that's covered, or get another rider. But many renters do not have insurance. Yeah, but that's more out of ignorance. It's really not that hard nor that expensive, so it's typically affordable. So something you should do. All the different forms for the different insurance. Not really that germane. We aren't going to worry about the numbers here. But when they talk about all risk, I've also heard the term all perils. So again, perils are things like rain, wind, earthquake, fire, those type of things. But different forms for different situations. Home insurance cost factors. They will come, and number one, though, if you ever get homeowners insurance, they're going to want to know what the structure is built out of. Part of this is, well, there's two things. If you've got a shake roof and you've got, a wood home, it may present more of a fire hazard. But the other reason they want to know about all these things are for the rebuilding costs, because they're going to estimate what it's going to cost to rebuild it. So they're looking at two things when they're, some of these factors. They're looking at the hazard you basically put yourself in wherever you live, based upon, earthquakes, avalanche, fire, all that kind of stuff. Then they typically will also come out to the house and just check on certain things. If you've got spruce trees right up next to the house, that's potentially a fire hazard. There's other things like that may make you more difficult to insure than others. They'll look at distances between two fire stations, and if there's fire hydrants, what's the proximity? Things like smoke alarms, different alarms. So there's a lot of different things that go into their plan in terms of the cost of it. Co-insurance and full coverage. Yeah, you want a full coverage policy. Actual cash value, cost less depreciation. Again, typically you want a replacement type policy, because you're going to have to, basically move on, and depreciated cost on all your household items. That's going to be kind of a mess. I've always been able to get replacement value type policies, and that's what you're interested in. The mortgage company obviously is collateral. they're going to want a fully built house. But typically, when they talk about these replacement versus depreciated value, um, they're mainly talking about the personal property items within the house. So, how much coverage do you need? Replacement value of the home, value of the contents, liability coverage desired, protection for such items. Some of the rider type items. But again, this issue of the value of the property is a factor, especially if you've got quite a bit of land. If you've got, a $200,000 house sitting on, $800,000 worth of property, well, you need $200,000 worth of insurance for that structure. You don't need to insure that land. Now, the liability insurance, if somebody comes on your property and hurts themselves, yeah, that's independent of that, and you need the full amount. Value of the contents, that's going to be a standard figure, and then any special items are going to be covered by those floaters that where you specifically identify the items. Replacement value, yep. Again, you have to read the fine print. I haven't seen this bit about the 400%, but cost 10 to 20% more than actual cash value coverage. In my mind, with the amounts we're talking, typically the homeowner's insurance is rolled into the mortgage, and it's not a significant amount of money, especially if you do it, per month. They'll have it broken down, and the peace of mind too, especially if that kind of, catastrophe happens. I think you're well ahead, but again, that's personal judgment. Factors that may affect it. So we talked about location of the home, type of structure, and the coverage amount, deductibles. You can go with a higher deductible. I often do this with auto insurance. Like I said, I had some, cars like, and well, that's more in the auto section, but I chose to go with incredibly high deductibles because the policies were just unaffordable without them. But the higher your deductible, the amount of money you have to come up with out of pocket before you can report the claim will definitely lower the amount. Reducing, yep, we talked about all the alarms. That's just good to have anyway. And then the companies, there's tons of information, especially on the homeowner side. Go with a company you know and you can trust. If you're lucky enough to have one that handles both auto and property, and you bundle that together, typically you'll get a better deal. But again, you have to assess once in a while, and it doesn't hurt to shop the competition and make sure that the company you've chosen is still the best choice. Automobile insurance. Okay, so we talk about this. The states set certain limits, minimum limits, okay? And then typically you have to have insurance in order to drive. You can self-insure, but that's not just as easy as saying, hey, I'm self-insured. You have to actually contact the DMV, and a lot of times you'll have to post a bond, put some money down, or show proof of assets so that if something bad happens, they know that you've got the means to cover it. So this is what they're looking at, and they'll quote these numbers, 100, 350, and they'll just roll off these numbers. But the specific order is typically standard. So that $100,000 is paid to one person in an accident. So $300,000 for the whole carload, and then $50,000 for the property damage to others. So they'll talk about bodily injury liability, so that's the medical stuff, and then the property damage is that last number. Now, you know what cars cost. You know that you can exceed these numbers. So, you just need to make sure that you can kind of weather the storm if you do exceed these numbers when you're talking to your insurance person. These are the Alaska numbers. Again, you can self-insure. You need to post a bond, or you need to buy auto insurance. If you do buy auto insurance, you can see Alaska's Not that high. 50,000 per person, 100,000 per accident, and then 25,000 in property damage. So that's pretty low. Most people would want to insure for more than that because they realize the risk that they'd be exposed to. So again, these are the numbers that the book was using as sort of a average state limit, and you can see Alaska's are quite a bit lower. But again, it's sort of the big boy concept. If you want to, this is the minimum. So most people in this case would carry just the minimum. Bodily injury, so the legal, medical expenses, lost wages, you can quickly get up to 50 grand. Medical payments coverage, health care, including yourself. Uninsured motorists. So this is the uninsured, obviously uninsured motorist. I mean, somehow it's going, just because you're getting in an accident, you want to make sure you have some protection. The no fault part, again, it depends on the state, but it's not always as fast or smooth as they say. But the intent is, accidents happen. Let's not quibble about who caused it, and we'll spend more time, in the legal system rather than just paying it off. So again, it depends on the severity of the accident. Property damage, again, kind of standard, covers damage to the other person's car. And then collision. Collision, this is a huge variable. I mean, if you want to reduce your automobile insurance, you take off the collision. Now, what happens though is you are now on the hook for accidents that you've caused to your own car. So, you still have the liability. You can't waive the liability coverage. You're still going to have to pay for the other person's car if you cause the accident. But if you cause the accident and you don't have collision coverage, your car doesn't get fixed. So, it's a tough world out there. But I tell you what, I was driving a Dodge Viper in Germany, and they have, automobile insurance, they have about 47 different categories they put cars into in terms of risk, and the Viper was number 46. So the insurance that what I would have had to pay for collision, I could have bought a new Viper every 2 or 3 years based upon the collision. I mean, it was astronomical. So that was the first thing to go, and you just had to be very careful, because if I caused an accident and my car was not going to get fixed, it was just going to be a total loss on my part. So anyway, it was the only way I could own the car. So you got to do what you got to do. If you have a couple different vehicles though, again, you can have different coverage on different vehicles. I only currently carry collision on one of the vehicles I own, and the other ones are all no collision whatsoever. So it's a risk. Comprehensive. So damage to your vehicle that is not caused by a collision, such as fire, theft, vandalism, hail. You have to be careful with this stuff, because that caveat down at the bottom, some things in your car like radios and stereo equipment are not covered. Also things that aren't, I had some aftermarket wheels on a vehicle, and they determined that no, they weren't covered, and other things weren't covered. And you can, whatever. When it actually comes to paying the claim, it can get pretty ugly. So you definitely need, in the comprehensive section of the coverage, you need to find out what's covered and what's not. And the most obvious example is anything that's sitting in the car, any material that you have that's not physically attached to the car, and they don't consider car stereos or even aftermarket speakers as being connected to the car. So their definitions are they favor the insurance companies greatly. So make sure you understand that, and don't think you're covered for something you're not. Wage loss insurance. Yeah, reimburse you for any salary or lost income. Um, I've never had that offered, and it would depend on the price. The towing and the roadside or the road service stuff, this is usually a no-brainer. We're talking a couple bucks a month, and it's, you know, a bit of peace of mind. Um, Again, it's up to you, but I carry it, and it's quite reasonable, and um, also, I drive some beater cars or trucks or horse trailers, things like that, and you find yourself in awkward situations. Again, you need to talk to the agent and get a price breakdown on every item. But I think for most of you, you'll find out that the towing and the emergency road service is well worth the value, especially you're stuck out at Fairbanks, something like that. You're talking some massive tows that can get pretty pricey. So again, find out what's coverage. If you're getting it for this massive tow from Fairbanks and you find out you've got a dollar limit or a mileage limit, typically most of these emergency roadside things, they will tow you to the nearest suitable garage. So it helps to have that kind of pre-identified before you break down. Evaluate the factors that affect the cost of automobile insurance. Okay, so we talked about the numbers. Um, you know, Basically, if you're sued, if there's four people in the car and they each have $100,000 worth of uh, medical costs or legal costs, you're $100,000 out of pocket. So that can be a problem. Again, uh, in this case, they've got this $1 million or more umbrella policy, which is quite helpful. So see what your policy entails. Vehicles have gone up. Again, that $25,000 that was the Alaska minimum standard, yeah, you can't get a whole lot for $25,000. So again, here they're saying $50,000 to $100,000. That's probably more realistic. That would, at least $100,000 would, well, it depends. You do a multiple car accident, you can zoom right through those numbers, but that would all have to be assessed as being all your fault. But again, that's what those numbers would cover in terms of the property damage. Premium factors, yeah, they're going to look at, obviously, the value of the car for the replacement, but also the desirability for theft or any type of system that you've got on it. I mean, when you go to insure a car, you definitely want to make sure that they know of any sort of theft type system you've got on there, whether it be like a low jack or just a simple car alarm. That's going to reduce your rates. Also, sports cars and things like that, people tend to drive a little faster, tend to get in a few more problems with them, so that's going to raise the rates a bit. The rating territory, yeah, we're kind of stuck there. Alaska's not going to be cheap. There's a fair number of ditch divers, fair number of perils to be found by drivers, so we can't do a whole lot about that. But yeah, it's going to depend on where you live. Crime-wise and all that, I think we're all right up in Alaska, but the natural perils are definitely prevalent. You all know about your situation, especially if you're a younger driver. Once you hit a certain age, get married, if you've got a DUI, gotta help you. That's a problem. But and that gets down to that next part, that assigned risk pool, the SR22 type folks. If you're in that sort of assigned risk, that is a problem. The law realizes people to a certain extent still have to drive to get to work, so they'll put you in some sort of high risk pool and get your insurance until they flat take away your license or whatever if you're a habitual offender. But insurance is again based upon the risk you present, and It's not that they don't like young folks, but you know, their statistics show them what the accident rates are. Reducing automobile insurance premiums. Compare companies. You can go with a larger deductible. You know, if you can handle it, you know, I often use $1,000 deductible, and you know, I'll carry some of the high dollar, the more the catastrophic insurance, and I'll just endure the fact that if I get in an accident, you know, I'll have to suck up $1,000 deductible. The other thing about these things too is when you're getting the automobile insurance, make sure you ask them about rental car coverage. Believe it or not, when you go to rent a car, your normal automobile coverage protects you, but you have to make sure what that coverage is. So, you know, that's the number one gouge with the rental car companies, is them trying to sell you secondary insurance. And number one, if you wreck one of their cars, even if you took their insurance, the first thing they're going to do is try and go after your insurance first. They will try not to even pay that extra insurance that you've taken, and then if they, whatever, otherwise it's just redundant insurance. Other things, I'm not sure the correlation of the non-smoker. Maybe it has to do with distractions or whatever. Obviously, you know, a lack of tickets, more than one vehicle. You can typically only be driving one car at a time, so that makes sense to them. And your driving record are all good things. All right, so that's it for the insurance aspects of what we've been talking about. Send me an email or give me a call or text or whatever if you've got any problems with the project, with the test. I've had to reset one or two people's tests. It's not a big deal. Just, you know, just got to get it done, and hope you all do well. Good luck.